For many years, one of the most common arguments people have brought up about real estate investment trusts, which I've regularly had to combat over time, is that they've been very poor investments for well over a decade. People have been pointing to some of the biggest REITs in the market, as well as various REIT ETFs and closed-end funds, and noting their lackluster share price performances when compared to the S&P 500. Most notably, starting around early 2015, these investments have seen their share prices more or less flatline over this time. And so for years, people who like dividend investments have been discouraged from holding these stocks because of how flat their share prices have been. This phenomenon has a name, which is referred to as the lost REIT decade. If you go on Google, you'll see a number of websites have talked about it, as well as plenty of people on various online forums. According to an article from Second Market Capital, between 2015 and 2025, REITs have returned a dismal 70%, which is 7% per year, while the S&P 500 has returned about 230% during that exact same time. They correctly point out that historically, REIT returns have actually been very close to the S&P 500. If we look at the full 35-year period, returns between REITs and the S&P are quite similar. Notably, the returns of both indexes are very strong. The other index they're referring to is called the Dow Jones Equity All REIT Index. According to an article in Institutional Investor just a few months ago, REITs were expected to benefit from the so-called silver tsunami of retiring baby boomers seeking a steady source of dividend income. But those predictions continue to fall short as both pension funds and independent financial advisors show little enthusiasm for investing in REITs on behalf of their clients. Nobody will return your phone call if you want to talk about a REIT, says Lawrence Glazer, co-founder and managing partner of Boston-based Mayflower Advisors, which caters mostly to clients with less than $5 million in liquid assets. At this point, he tells clients who don't hang up that REITs should be considered a contrarian play. As a very passionate dividend and income investor, I just don't understand the hate for REITs that have been around for years at this point. So I want to talk about why people should not avoid REIT investments. Let's go ahead and pull up a chart of ticker VNQ. This is the Vanguard Real Estate ETF, and it's one of the largest REIT ETFs that currently exists. It's a very well-diversified REIT ETF that holds REITs across all the major categories, including hotels and offices, to experiential REITs and more. We can clearly see that between 2015 and 2025, this fund's share price has remained pretty flat. The total share price returns between October 9th, 2015 and October 1st of 2025 has only been 15.91%. But this, of course, does not take dividends into account. The absolute worst argument that I continue to see against dividend investing is that dividend-paying investments should be avoided because they usually see less share price appreciation. Looking at the share price performance of a REIT, a utility stock, a BDC, or any other dividend-paying investment alone will not give you an accurate return. You have to use a dividend reinvestment calculator anytime you want to see the total return of a dividend-paying investment. REITs are known for offering higher dividends than nearly all S&P 500 stocks, so it's a component that you can't just leave out. However, as mentioned in one of the articles, even if you do take the reinvested dividends into account, the REIT sector has still underperformed, so let's keep going. Let's go back to that share price performance graph. What you'll notice is that the lost REIT decade really only started in 2022, about 3.5 years ago. Between 2015 and 2022, REITs were still performing very well. But of course, we all know what happened, which caused the share prices of REITs to fall. This all started back in 2022, so it's not really correct to say that they've been struggling for a decade. It's only been the past 3 years, and REITs weren't at fault for it anyways. There's nothing fundamentally wrong with them. As I've been highlighting over the years, most have been continuing to go on as normal in our higher interest rate environment. To give just one example, since 2022, realty income has more than doubled in size, growing from about 6,600 properties to now over 15,000. Agree Realty, Triple N REIT, and many other companies in this sector are now much bigger than they were before the year 2022. When speaking about their dividends, despite share prices falling across this sector, we haven't seen widespread dividend cuts like you might expect. Just reflecting on how much they've fallen, you might assume that dividend cuts have been rampant. And while that has been the case for mortgage REITs, it's not been the case for equity REITs. According to NAREIT, there's more than 225 publicly listed REITs on American exchanges. In 2023, we saw 8 companies cut their dividends, according to SP Global. And about half of these were cyclical REITs. These would be companies that I describe as holding things like business offices and not medical offices, and also hotels, which are property types that don't weather all economic conditions, and which I personally don't like to hold any of them. I also just don't like recommending them for long-term buy and hold investors because when the economy gets rough, then we often see them cut their dividends. It was a very similar situation in 2024, although a little better, where we only saw 5 REITs slash their dividends, and most of them again were office and hotel heavy. But across the entire sector, most companies have been fine and have even grown their dividends. If you look at VNQ, again the Vanguard REIT ETF, this fund has continued to grow its dividends since 2022, and you'll find that's the case for all diversified equity REIT funds. And what also needs to be said in this discussion is that if you are a dividend investor, then you're not playing the same game as a growth investor. Your priority should be collecting stable dividends, not trying to match share price appreciation with the market. Of course, you don't want to see your investments fall in value over time, so I'm not saying completely disregard share price appreciation, but it's not your number one goal. We just talked about how dividend-paying investments usually see less share price appreciation because their dividends make up for those returns. Caring so much about share price growth makes even less sense if you're retired. If you are living off dividends, then why do you care so much about daily share price movements of your holdings? The only thing it's going to do is stress you out. I occasionally talk to dividend and income investors who seem to care a lot about share prices, and so much that they seem to want their dividend investments to rise in share price as much as the S&P 500. And the advice that I would give these people is that if you care that much about share price appreciation, then perhaps you should think twice about being a dividend investor. Given how strong most of these companies are in this sector, if anything about the performance of REITs has been showing you, it's that now is the best time to buy while they're discounted, not avoid them. Following the pandemic, I've easily bought over 6 figures worth of REITs because even today they're still on sale. Anytime you buy a dividend holding that's on sale, you're going to get more dividends for your investment dollar, and that means you're going to be closer to retiring off dividends, if that's ultimately your goal. Every time I buy a discounted REIT, I'm going to earn more money than had I bought it back in early 2022. So dividend investors should be celebrating this opportunity to buy these investments. And now that interest rate cuts have started, we're now going to see the environment for these investments get much better. So now is a great time to not avoid REITs. But feel free to let me know your thoughts. And with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.